Hey, podcast listeners, so excited for the release of the second episode of the Advice First podcast presented by Prosperitas. In this episode, we interviewed Christopher Ingram, and Chris is a 22-year independent financial advisor. But not just that, he's also the CEO and co-founder of Prosperitas Financial. And in this episode, we really dug through, how to take in and what to consider when we're reading a lot of these financial headlines and what we're seeing in the media and some of the myths and blunders of what we might find in some of those content pieces or what others are saying. And then Chris really dives into the difference between investing and trading. And then lastly, and perhaps most important, at least my favorite, Chris actually remembers the one piece of advice he shared with me 8 years ago. And this is that one thing that I constantly refer back to as a life-changing moment as a young professional. So I hope you enjoy. There's a ton of great info in here, and please let me know what you think. Welcome to the Advice First podcast. Christopher Ingram, thank you for joining us on the exciting second episode of the Advice First podcast brought to you by Prosperitas. How are you?
I'm amazing. This is wonderful.
It's pretty exciting, right?
I like the foliage wall and the wood table. I'm glad to finally be in this studio after everything we've been through. It's exciting.
Absolutely. And if you're listening to this podcast, highly suggest you check out our YouTube channel. Advice First is the name on YouTube. That way you can see the beautiful boxwood wall that Chris is referring to. And for background, I know I kind of explained it in the introduction, but Christopher Ingram is a longtime financial advisor. He's the CEO and founder of a firm called Prosperitas. You might recognize that name as the sponsor of the Advice First podcast, and we are recording here in the Prosperitas office. And really excited about what we're going to cover today because just for a sake of reference on timeline, we've just gone through what was referred to as a pandemic related to COVID-19. And as many of you are aware, that had drastic financial impacts attached to it. And so I don't want to steal the thunder, but I wanted to get Chris in here because he is a financial guru, one, but two, he is my sound reasoning board whenever financial questions come up. As we went through this pandemic, there were a number of things happening and people making suggestions, whether they were on TV or just your friends and family. And so we want to talk about some of those. And so I want to throw it out to Chris, first off, as an investment professional, what do you see, and does it make you cringe as much as it does for me? And are your clients voicing these? Where do we go?
Yeah, no, I appreciate the setup. It's one of those things. Does it make me cringe? A little. I think the thing is that it's because of the reaction I know that other people are having from watching it. So, as a financial advisor, I think back to what I do for my clients. And, honestly, I got to be honest. It doesn't feel like a lot of my clients pay attention to this stuff or listen to what they see on TV or social media. And maybe that's because they're not paying attention, or maybe I like to think that maybe they just trust the process that we have them in. And so they're not as concerned with that stuff because they feel, and I have clients tell me all the time, I wasn't concerned because I assumed that you were taking care of it, and if you weren't, you were going to call me and let me know that there was a problem. So I appreciate my clients for that and feeling that way. But I still understand what they're watching. And when I watch these shows or I see things on social media, I know what some of this information does to people. And so it irritates me a little bit because I know the reaction, or maybe I'm more concerned about what kind of reaction it may cause and the negative impact that might have on an individual or somebody's portfolio or whatever it may be.
Yeah, absolutely. And so let's talk about a little bit about some of the predictions that we hear. And COVID, pandemic or not, you constantly hear people trying to make predictions.
Right.
Are predictions even valid in an investment environment?
So like I often say, and this is my theory, and I don't know that this is 100% true, but I feel like a lot of guys in our industry, they make these big, giant, bold predictions. And if they're wrong, nobody talks about it. I scoured the internet the other night looking for some of these big, bold predictions I've heard in the past that were drastically wrong. And I even think they're hard to find on the internet. I think their team goes in and wipes those things out. You can't find them anywhere. So the big, bold, negative, wrong predictions, gone. Nobody talks about them. But if you get one right, if you hit one on the nose, from that point forward, you are always that guy or gal who called the bottom or called the top and then from that point forward, you've got books and websites and TV shows and things that you do all based on the fact that you made this big, bold prediction and you were right. You were so smart. And so I think sometimes guys are just throwing stuff against the wall to see if it sticks. And if it sticks, they know that they can make a career off of it. So sometimes I wonder what the true motivation behind those big, bold predictions actually are.
Absolutely. I mean, if you get it right, Hollywood might even make a movie about you.
For sure.
And it's happened
I'm
before.
pretty sure they did.
Absolutely.
Yeah.
And what's also interesting is our media channels, or the channels that we consume, it is more immediate than it ever has been. And so sometimes some calls or some influential people will actually make a prediction knowing how a community will react to that and align themselves with something that rewards them once that action is taken by the thousands or, middle income America.
Right.
That's something that I struggle with. I think what's really interesting, though, is even if someone makes a right prediction, that doesn't mean it was right for everybody.
For sure.
As we were kind of going through, the myths and blunders of what we experienced in the pandemic, I also recall seeing things online, and I would say because they weren't, your mainstream media sources, there wasn't as much of a filter, right? You could actually find Bill Clinton and Jeff Epstein in the same photo. Right. They didn't have their crew to clean it up. And what was interesting was going back to some of those posts as we were preparing for this today. And, the number of suggestions that people were making, whether that was to sell their equities, to buy into equities at a certain time, or to transfer to precious metals because that had the most optimistic outlook going forward. The fact that, to call any of those wrong, it would also be false because to some individuals, it could be the right play. Right. To the people sharing their opinion, it could be the right play for them. And so I think that's a big factor. And I know that's something that you pride yourself on is, there's no one single way to accomplish the goal before you. And likely the person sitting next to you does not have the same goal, nor are they starting from the same position. Would that be an accurate statement?
100%. Yeah. So that's the thing is when I go through a process with a client, when you bring in a client, we're not just bringing somebody through the door and immediately deciding, hey, let's invest their money. Let's do something let's just throw them in that same product we threw the last person in. We're very much trying to understand that client's goals and objectives for the future and make sure that we're putting together a very unique and detailed specific plan to that individual. And so every client is drastically different. So when you're trying to build and design a plan that is very unique and specific to that individual, it can be frustrating when outside sources are making recommendations that don't apply to that individual because they don't understand that individual's needs. And so I take a lot of pride in the fact that I don't use a one-size-fits-all methodology for my clients. I very much custom tailor everything we do to that individual client. But the media doesn't know that. Social media doesn't know that. So we put all this hard work into creating this custom plan and making sure that all the details and the investment strategy and the risk tolerance and the time horizon and all those things are well thought out for that client. and then they tune into a television show and they hear somebody who is recommending something, and that individual on the TV show has no clue who my client is. They don't know that they have 3 children that are going to college. They don't know that they're in a higher tax bracket or a lower tax bracket. They don't know that they're going to retire in 10 years or 30 years. They have no clue what that information is. So when they make a bold recommendation on TV, sometimes clients, because they don't fully understand where that recommendation is coming from, they take it at face value and think, oh, he's telling me to sell, I should sell. And what they realize later, or what I try and explain to them, is he's looking at it from a very different perspective. He might be thinking about his money. He may be thinking about the mutual fund that he runs. He may be thinking about his hedge fund that he runs. He may be thinking about his 85-year-old mom. I have no idea who he's thinking about when he makes the recommendation. The only thing I'm 100% sure of is he's not thinking about my client or thinking about the individual that's watching that TV show. So the recommendation can sometimes, where we get frustrated again, is sometimes it can blow up a very well-designed plan because a client is now taking a recommendation from somebody that really has no understanding of their situation.
Yep, absolutely. I could not agree more. And a lot of the points that you mentioned, it's interesting to hear. I consider you more of a comprehensive financial planner or advisor, and that does not equate to I'm purely an investment manager. And I think that's skewed from a public perspective. So as a consumer, Chris, how, if I'm leaning on you for guidance, how critical is just the investment side of things? I tend to feel like, we're all in it to get the best return on investment that we possibly can. But at the end of the day, where does that really weigh out when we compare it to the entire plan?
Right. Yeah. And I think part of that is the way the industry has handled clients through the years. Stockbrokers, back when I first got into the industry, so I've been an advisor for 22 years. So I got in the late 90s. When I first walked in the door, everybody was still stockbrokers. They didn't even call themselves financial advisors at the time. They were stockbrokers. Their job was to sell stock to people. And so it was focused on the investment side of things. We're selling investments to people. It's so far from what I am as a financial advisor. And I think clients are even surprised when they meet with me when I first explain what my services entail, and I say, okay, the first thing we're going to do is I want to know everything. I want to know not only where your investments are, I want to know what your mortgage looks like. I want to know what your budget looks like. I want to know what your income looks like. I want to know what your health insurance and property and casualty insurance and what kind of credit card debt do you have, and what does your life insurance look like, and long-term care, and have you thought about the kids and college education, and so on and so on and so on and so on. There's so many things that I'm trying to understand about that client so that I can put together a very well-designed, comprehensive, holistic financial plan for that individual. And so the investment strategy, when you see one of my financial plans, let's call it, just for ease of numbers, let's say there's 100 pages in a financial plan. Maybe 15 of them have to do with the investments. The rest of it is all about everything else. It's going to figure out how much can we save and what are our goals for the future and how are we going to buy that house or the investment property that you want to buy, or do you want to own apartments at some point, or what are all the different pieces that come together. And it's very comprehensive in nature. Investments are key. They're a very important point. We want to make sure our investments do what they need to do in order to help us accomplish the goals. But ultimately, the goal is the goal. We're trying to get somewhere in the future, and we're trying to tie all those pieces together to get there. And the investment piece is just a small little piece of that.
Yeah, absolutely. I absolutely love that. And so for the listeners who don't know kind of the background of our relationship here, one of the reason I've always admired Chris and what he does is because it was probably 8 years ago or so, I saved up my first $50,000 and I felt like the richest man in Los Angeles. And so, knowing Chris and knowing he was a financial advisor, I asked him for coffee, or asked him to coffee. And I clearly remember, presenting, again, showing my cards as if I had just struck the lottery, saying, what should I do with this money? And he gave me the best piece of advice that has changed my career for the last 8 years. And nothing has resonated more with me than that one piece of advice, knowing that he could have taken the $50,000 check and then said he was going to invest it and earned his commission or his fee based on that investment. Chris, do you recall what that advice was?
I do. I said, invest it in yourself, put it back into your business and your career and what you want to do to grow and parlay that into a much bigger thing. Because you were early in your career, and it was all about putting that money back into building your business, your brand, and who you were going forward. Yeah. And I think it worked out really well for you.
Exactly. I bought 2 microphones and some podcast microphone booms, and 8 years later, I finally got my second episode out.
Here we go.
Yeah. Okay. So I love the comprehensive picture. But going back to where we started, on where media can sometimes let individuals down if it's not taken with the right perspective.
Yeah.
So much of our headline, especially because, the way the algorithms work, if you are one that enjoys looking up investment perspectives, you are going to be fed more investment perspectives from whether that's social media or, your news feed, your Apple News, what have you. And so remember, that is one piece of the plan, just like Chris said. And I want you to be cautious. I believe you had a good subject line that you were referencing earlier, and maybe you're not going to recall it because you can't read my mind. But it had to do with are investments better or annuities better? And it was just the way that the subject line was titled. Do you know what I'm talking about?
No, you lost me.
Shoot.
Yeah, I wish I did.
The way it was titled. Oh, it was today's article. It was today's news. It was stocks are down it wasn't due to, but it was referencing coronavirus.
Got it.
Cases have increased. Mm-hmm. Here we're recording this on June 24th. So COVID-19, there's, after the protests and things like that, they're saying COVID-19 cases are up. And they threw, a title or kind of a clickbait title that said stocks are down today. Mm-hmm. That today wasn't a good day for my $50,000. Stocks are down and COVID cases are up. But the way they phrased it was that it was a cause relationship.
Right.
Which
is silly. Headline risk is crazy. That's something that people need. So here's the other problem is people are lazy. Inherently. If you're listening and you're not lazy, I'm sorry. I didn't mean to call you lazy. But naturally, most people read headlines more than they read the article. There's proof in that. And so headlines often, have you ever read an article that you read the headline and then you read the article and you thought, it's not even close to what the headline said. The headline just reeled me in. Well, if you don't read the article and you just read the headline, you may make a decision based on the headline that has nothing to do with what even the author of that piece was trying to get across. And so that happens a lot in this industry. I read a ton of articles and I'm thinking the headline was so drastically different. The headline's scary because it's clickbait. They want you to click on it. And so what happened today is you said, what do you think about the market? Market's down. And coronavirus cases was the headline. And really, the reality is there's several people in the industry that probably could have told you a couple of days ago that things are going to be volatile here at the end of the quarter. At the end of the quarter, there's a lot of repositioning and changing and profit taking, and mutual funds are repositioning their top holdings in the portfolio. There's just a lot of stuff that goes into ending and closing out a quarter that can create a lot of volatility. You've had a quarter that the market has run up incredibly. We've had a great quarter. quarter since the bottom on March 23rd. So a lot of people are sitting on profits, and there's a lot of things that they're looking at names and going, I don't need that company. I'm going to rotate some money over to things that are slightly more conservative. So there's a lot at play here besides just the coronavirus cases are up, which is what the headline led you to believe, is the market's falling because of coronavirus cases. And so it's misleading in nature. Now, are coronavirus cases up a little bit and there's a little additional fear there? Sure. But there's so much more at play here than you can't just dumb it down to one little thing.
Yeah, absolutely. I could not agree more. And still to think that title, even if you believed it, that could sway life-changing actions, and yet that's only worth 15 pages of your 100-page plan.
Right.
And so people making life-altering decisions based on just such a minor part of the bigger picture is kind of upsetting. Any other words of caution you have to share with listeners?
Yeah, so let's continue. We talked a little bit. First of all, here's my big word of caution. Protect yourself on social media. Okay, social media, there's some true media outlets that you can read the articles from professionals in the industry. Those are scary, and I'll get into that in a second. But friends, family, uncles, sisters, mothers, cousins, brother who used to be a financial advisor 17 years ago, that they're so adamant about things on social media, you really got to be careful with that kind of stuff, because not only do they not know who you are, and they're not actually aware of who you are in your situation. They're also not trained. They're not licensed. A lot of times I read their stuff and they don't know what they're talking about. They're regurgitating stuff that they read that they didn't fully understand the first time they read it. So just be very, very careful of people making predictions or telling you what to do on social media. Besides that, going back to professionally done people on media, like television, print, whatever it may be. Some of these guys are great, and I don't want to knock any of them. I think some of them are geniuses. They're very smart. They manage big books of business. They know what they're talking about. They can just be wrong or misleading at times, and so you have to understand that. So misleading, first of all, there's a great show out there. I love it. I think the guys on it are great. I watch it all the time. I think they're funny. I think they give good information. The show is about trading, and most of my clients are investors. Difference between that is a trade is I'm buying it today. I'm going to sell it in the short term at a profit. Investing is I'm going to buy and I'm going to keep buying and I'm going to keep buying and I'm going to keep buying and I'm going to hold it long term until I need to turn around and start spending it for retirement or whatever the purpose may be. There are two very different reasons that you invest in the stock market. Trading is fast. You want to get in and out and you want to get a profit. When you listen to the show, though, they'll say, I'm a seller of this market. Well, what you don't know is that he was a buyer 4 days ago, and now he's a seller today, and he's going to be a buyer again 2 days from now, and he's going to be a seller 4 days after that. But if you only hear, I'm a seller of this market, and you decide to call your financial advisor and sell out, what you don't realize is that guy's getting back in 48 hours. And if you're not getting back in 48 hours, you're missing out. Like you just lost the whole purpose of your investment strategy. So understanding where the information is coming from and how it applies is super important, because people are just talking about different stuff. And if you don't watch the show regularly, you might not understand that or fully grasp what they're getting at. That's number one. Number two is that sometimes guys they're just wrong. It's unpredictable. The market is unpredictable. You cannot predict where the market's going to go in the short term. In the long term, I feel way more comfortable telling you where I think the market's going to be 10, 15, 20 years from now. Where it's going to be next week, nobody knows. Nobody. You look at trades that Warren Buffett has made recently. I've seen years where the market's positive and Warren Buffett is actually negative in an up year because he was wrong. He played his cards wrong. He's a genius. He's a great investor. He just gets it wrong sometimes. So I'm going to actually read these because I don't want to get them wrong, but I'm just going to throw a couple of pieces out there. Here's one. On March 4th of this year. So the market bottomed out on March 23rd. So on March 4th of this year, the market had already started falling, and it fell considerably in March. There was a very prominent TV personality who came out and he said, and I'm going to quote it on March 4th, "I expect a mild recession based on weakness in travel and entertainment. But right now, the oscillator is saying you should buy stocks, both short and long term." Okay. The problem with that is that over the next 2 weeks plus, the S&P 500 index dropped 26%, over 26%. So if you took what he said on March 4th at face value and you bought into stocks because his oscillator told you to, and you're flying by the seat of your pants based on what these guys tell you on TV, you watched your investment go down 26+% in a 2-week period from there. He was wrong. He was just flat out wrong. He got it wrong. That same gentleman, though, on April 4th, so the market bottomed out on March 23rd and started to turn the corner. On April 3rd, he was singing a very different tune. He said, and I quote, "Not a recession, a depression. The bad numbers are just beginning." Okay, so that was on April 3rd, just days after the market bottomed out. And if you look at the S&P 500 from April 3rd until today, the S&P 500 is up 25% from that time when he called it's going to be much worse, we're going into a depression, and here we are up 25%. So if you're watching that TV show and if you're actually taking everything he say as holy grail, and you sold out when he told you to sell out, or buy in when he told you to buy in, and sold out when he told you to sell out, you got your you-know-what handed to you over that 2-month period. Here's another one. This is a very well-known economist that just reiterates what he said on April 3rd. This economist he's so smart. He's a genius. But on April 3rd, he said, "I don't think we have formed a bottom yet. I think we are going down at a slower rate." Wrong. I mean, he was wrong. Market went up. Market went up from there. I mean, we had found the bottom. He was just flat out wrong. Doesn't mean he's not smart. It means he was wrong. And if you were trading long-term money with short-term thinking, you got into trouble from that. And then I'll throw this last one out there. This is an older example to just show you it's not just this year. In 2018, if you weren't paying attention, the Federal Reserve came out in September. It was right around September 21st. And the Federal Reserve basically said, we're going to raise rates one more time in 2018. We're going to do it, I think, 3 or 4 times in 2019. And then we are going to raise 2 times in 2020. And the market freaked out, thought there's no way we can handle those kinds of rate hikes. We're going into a recession no matter what. That's crazy. And so the market started to fall. Well, the market fell from whatever that was, September 21st, I think it was, through till Christmas Eve. Over that time period, it dropped about 20%. Christmas Eve that year in 2018 was the worst Christmas Eve in the history of the stock market. And I know because my Christmas Eve was spent sitting at my desk, staring at the stock market, placing trades for clients instead of enjoying Christmas Eve with my family, because it was crazy. The market was dropping like a rock, all because the Fed was being overly aggressive with raising interest rates. So we have this gentleman who is on television. And on December 27th, just days after Christmas, he came out and he said, quote, "The worst is yet to come." And then he showed a chart and he gave investors the impression by showing this chart. He said, when you have a drop like this, this is on average how long it takes to recover your money. And on average, according to his chart, it takes 4 years and 7 months to recoup losses and create new highs from a drop of 20% like that over that kind of time period. And guess what? If you're paying attention, you realize that he was wrong, because the S&P 500 recovered and it reached new highs in just 4 months into 2019. In fact, from his little prediction on December 27th, when that show aired, until February 19th of 2020, the S&P 500 went on a run of 36%. It only took 4 months, not 4 years, but 4 months to recover and get to new highs. And we had a fabulous 2019. We went up 36% from his bold prediction of the worst is yet to come and we are going down further. And again, if you listen to him and you took him at face value, you probably sold out. You probably missed 2019 and you probably have a lot less money in your account than you should. And that's the problem with listening to these guys. Now, all three of those guys are very smart guys. They have a lot to offer and they run portfolios and they're great money managers, but you have to understand that they probably don't know what you're dealing with. And then the other thing is that the Fed shortly after that came out and said, we're not going to raise interest rates in 2019. We're going to play it by ear. And you know what? He probably retracted his, the worst is yet to come. And he probably reinvested his money too. But you didn't see that because you didn't tune into that episode. All you saw was the worst is yet to come. You cashed out, you put your money on the sidelines, and you turned off your TV because you thought, I don't want to see that anymore. And then you sat in cash all of 2019. But the guy who told you to go to cash, well, he got back into the market because the Fed changed its tune shortly after that. So if you're not going to be active and continue to watch and understand and do your research, this stuff can be very detrimental to your long-term success.
Yeah. So like, what do you suggest? Do you just not pay attention to it at all?
So no, I think the title of my little thing here was to take it with a grain of salt. Okay, it's good information. Take it in, look at it, understand it, but then contact your financial advisor if you have one. If you don't have a financial advisor, do more research. But I also say the first thing that you have to do is focus on what was the plan originally. If you don't have a plan, go make a plan. That's the most important thing. Have a plan. If you don't have a plan, you're just flying by the seat of your pants. You're probably not going to be successful. I'm sorry. So go create a plan. If you have a plan, don't change it on a whim because of some guy you saw on TV. Understand what your goals are, understand what the plan is, and stick to that plan. If you're going to make changes, make small changes, tweak. Okay, if somebody says cash out, maybe pull a little bit out, maybe make a slight adjustment, maybe understand why you're making that adjustment and make a couple of tweaks to, I don't want to own this stock anymore, I'm going to switch to this stock over here, whatever it may be. But don't go just cashing out and making big grandiose changes to your plan just because of something you saw on TV. So, and you know, if you're doing it yourself and you're having success, great, keep doing that. If you feel uncertain and if things like that cause you to panic and sell out, then hire a professional that can talk you through it and help you better understand what you should be doing with your money.
Yeah. Do you feel like you're more of an investment manager or a psychiatrist?
Yeah, I definitely, you know what, I always say that when I was in college, I actually really enjoyed psychology. And I feel like I'm relatively good at it. And I think it helps out quite a bit because you do have to use some psychology. You have to know how to relate to individuals to kind of talk them off the ledge or make them understand what the original plan was and what refocus them. Remember what your goals are. This doesn't have anything to do with your goals. So let's refocus on the fact that, you know, little Johnny's not going to college for 14 years. Okay, so what happens over the next 6 months? It's not that important. So let's just focus, continue to add to his account. Let's focus on getting him into Stanford and not worry about what Joe Schmo said on television.
I love that. That is sound advice. And it just so happens to be the name of the podcast, so it couldn't be more fitting.
I mean, it's got to be. You got to, you know, advice first.
Yes, absolutely. So you know, actually, you said something earlier, and it made me want to ask the question, not to be rude or harsh or direct, but more because I know this is a thought that goes through people's minds, right? If someone tells you to not listen to another person, whether they're famous or on TV or what have you, if someone tells you, hey, don't listen to them, that, you know, they're what they're saying may be inaccurate, okay, but why would I listen to someone like you?
Right. Fair enough. I think that's a fair question. So I think, first of all, I'm not saying don't listen to them. Listen to them. but take it with a grain of salt. Understand where they're coming from. Try to understand where they're coming from. If you're watching a trading show, try to understand that it's a trading show and look at what they're recommending based through their lenses, the way they're looking at it. So I'm never going to say don't listen to anybody. The difference, though, really, and why you listen to me is because of the care that's taken in understanding the client's goals. So we're not coming from a place of randomly throwing advice out there. I've actually met with clients in the same day where I'll give different advice to different clients because they're in different situations. When I have a client that is older and is overly risky with his investments for his age. He chooses to be that way. When all of this started to happen, the contact to him was, hey, we need to dial it down a little bit and just make sure that you weather this storm better than other clients. So, and then another client I met with in the morning that's in their 30s, I'm like, don't even worry about it. Just leave and let it run its course. So our advice is coming from a place of understanding who that client is, what their goals are, what their objectives are, the difficulties they may face, and what we need to do to protect and take care of that client. Because ultimately, everything we do, all the advice that we give to clients, that's the place it comes from. Me in particular, I always come from a place of wanting the clients to be successful, to fulfill their goals. So if I'm going to give you advice, it's never going to be based on you clicking on my headline or watching my TV show. It's really coming from a place of trying to really give you the best possible advice and make sure that you're making good decisions going forward, because ultimately I want to see you reach your goals. But to sum it all up, it really comes from an understanding of that client. We have that, the people on TV don't.
I love that. That is very sound advice. Yet again, I think that's number 2. Piece of sound advice you've given here in the tail end of the moments. Do you have anything else you would share before we sign off? I feel like I might even have to release this into 2 different parts just because there's so much to unpack from this.
Right.
Do not, if you're listening to this, do not take these principles lightly. And like Chris is suggesting, you take some things that you hear here and you do your own research into, hey, perhaps they're true, but perhaps they're false. Maybe even go back to some of the things that you were paying attention to over the last year or so and get the feedback loop going of, hey, was that the right thing to do or the wrong thing to do? And how can I course correct going forward? Do you have any final parting thoughts here?
No, all I would say is that, where we sit today, now everybody's asking the question of, has the market gone up too far, too fast? And are we going to see the economy close down or shut down again due to a rise in coronavirus cases? And is the market going to suffer because of that? And so I will encourage people once again to focus on what your goal is. If it's long-term, understand what's going to be best for you in the long run. But more importantly, now is probably a great time as the market has recovered and you're kind of getting close to either back to even, maybe you're in positive territory. I have quite a few clients now that we're back in positive territory year to date. I have some accounts that have done really well year to date. Now you're in a place where you're back to all-time highs. You have the most money you've ever had. The one sound advice I can give to everybody is maybe now's a good time to go reassess the risk in your portfolio and make sure that it's in line with your goals. Maybe you at some point got too risky, or maybe you got too conservative. Maybe you made adjustments over time that your portfolio is now not properly aligned with what your goals and objectives are. And now's a great time, because we're in a happy place where things have recovered, to go just sit down, look at it, and make sure that it fits your goals and objectives.
I love that. And that was one of the pieces I was really thinking about when I suggest going back to re-listen to this, is that, every action you take should be with the focus of that North Star, of that, what do you want at the end of the day? What does your plan say? Because that is the best piece of information to pay attention to. And I look forward to many more of those insights from you. I know this isn't the only time you're going to be on the podcast, so I'm very excited about that. And I'm sure we have a lot more to learn from you, Mr. Ingram.
Well, I hope it's not, because my office is right across the hall, so so I should be able to at least come over and visit once in a while.
We'll see. Next time, bring that Tito's that you promised.
Yeah, I know. We were supposed to have Tito's tonight, but I dropped the ball. Too busy. What can I say?
Exactly. Chris, thank you for joining us today. It's been a pleasure.
Yeah, thank you. I appreciate you letting me be the number 2 podcast. I'm honored that I get that spot. So
absolutely. Thank you. Securities and investment advisory services offered through Next Financial Group, Inc., member FINRA SIPC. Prosperitas Financial is not an affiliate of Next Financial Group, Inc. This material is not intended as an offer or solicitation for the purchase of sale of any security or other financial instrument. Past performance does not guarantee future performance. All the views expressed are those of Robert Clark and Prosperitas Financial, and not of those of Next Financial Group, Inc. Next does not offer tax or legal advice. The S&P 500 is a market cap weighted index composed of common stocks of 500 leading companies in the leading industries of the U.S. economy. The Dow Jones Industrial Average is a price weighted index of 30 actively traded blue chip stocks.